Hey, what's up? I'm Russ. Thanks for clicking on the video. But before we get started, this is not a normal video. It's going to be a lot quicker, a little bit less editing going on because it's been a hella busy week for yours truly because I've been super busy with work, super busy with family, kids in sports, things like that. But I still have some information I want to get out to you, so it's going to be very quick, so hold on to your pants. And one last thing before we get started, I do have a free weekly newsletter which you can sign up for in the description below. And I would also love it if you would join me on Blossom, the social investing app that is free. Click that link. I get a very small commission if you want to show me your thanks and your love. I will be forever grateful. First things first, I ran a screen on Simply Safe Dividends, which we'll get to in a minute, but I had some information that I read through. I picked out 3 of the stocks you're going to see, and I got this information predominantly from a Morningstar report, which is super helpful in getting a good foundation in analyzing stocks. Now, I got this because I have a Schwab account. Hey, you can sign up for free, so this is a bit of a hack. You can sign up for free at schwab.com, and you will get access to hundreds, if not thousands, of Morningstar reports. So here we are on Novo Nordisk, ticker NVO. And right here in the middle, under this ratings and reports, they have a few. They have Morningstar, CFRA, Argus, Market Edge, LSEG. But I like Morningstar, so right there, if you see that little blue link, you can click on it, and it'll bring you to the Morningstar report. 22 pages long. They give a fair value estimate, which this shows Novo Nordisk at $86, and the last price when this report was put out, which they show here was January 16th, 2025, it was $83.07. So according to Morningstar, it's about 3% below their fair value, which is this 0.97. Hey, remember, if it's 1.00 fair value, anything over is overvalued and so forth. But they'll have a CFA. In this case, it was Karen Anderson, who is our analyst. Hi, Karen. And she will give you a really nice and in-depth overview about the business, what's going on, any concerns. Here we see that they're currently battling Eli Lilly for a share in the potential $200 billion GLP-1 drug market. And when we scroll down, there will be a business strategy and outlook. Now, this is from May 2nd, 2024. The most current stuff will be at the top, but it's still really good information to give you a grasp on the business. And then they always have the bulls say, bears say, where they will give you 3 bullish thoughts on the company, and then the bears say, 3 bearish thoughts on the company, things you should be aware of. And then they will also show some of the competitors, what their valuations are. This is all free, super helpful. So yeah, sign up for Schwab. I thought about sharing these PDFs, but I don't know if that's going to break any kind of copyright infringement. So hey, if you want to look at all this stuff for free, just create yourself a free Schwab account and you can get access to the Morningstar report. And then if that didn't sell you enough, good old Karen Anderson in June of 24 had a whole big write-up about the economic moat of Novo Nordisk, leading in then to the fair value and profit driver. So it is just a really cool report. You'll be up to speed on these businesses, so I would highly recommend it. And now we're at simplysafedividends.com. It's grade A. I love Simply Safe Dividends. I've been using it for a long time. I'm not an affiliate. This is not a sales pitch, but this is to tell you that you can use it free for 2 weeks, and all you do is just give an email address, no credit card, anything like that. Free 2 weeks to use Simply Safe Dividends. Now, a new feature that Simply Safe has just started using, they hooked up with Standard & Poor's to show credit ratings for a stock. And a high credit rating is fantastic because when a company has a higher credit rating, they can borrow money cheaper, so they will have more cash left over to pay you a hopefully growing dividend. And a high credit rating is kind of like a credit card score for any of us, where it shows that we're good for the money. If we borrow it, we're going to pay it back, so we're less of a risk, so we get more favorable terms, and it's pretty much the same thing for a company. And lastly, a good credit rating is a sign of financial strength. You've probably heard it before that Johnson & Johnson and Microsoft are the only 2 companies that have a higher credit rating than the United States government. So it shows that these businesses, in the event, it's like a fortress, right? In the event of a terrible storm, hurricane, whatever you have, they're more likely to withstand it than companies that are drowning in debt and have really poor credit ratings. So I ran this screen on simplysafedividends.com. I put in a dividend safety of borderline safe or up, a valuation of undervalued according to Simply Safe Dividends. Hey, pop in on a live stream sometime and I'll explain it. I do them on Sunday nights. Credit rating of very strong or strong. 5-year dividend CAGR, the dividend growth rate of over 8%, which is very fast. I got 18 matches. I set up some columns here, so pause the video if you want to look at any of these a little bit more in depth because we're going to go quick. But we got the name, the valuation, starting with the least undervalued according to Simply Safe Dividends, the dividend yield, dividend safety score, all self-explanatory, the 5 and 20-year CAGRs, if there is a 20-year CAGR, the dividend growth streak, the credit rating, the payout ratio is earnings per share. I like free cash flow payout ratio, which Simply Safe does share. My man Kevin Burgess likes the earnings per share payout ratio. Hey, to each their own. And then how many years did they have positive free cash flow in the last 10 is the very last column. So knock your socks off. Number 1 here, the least undervalued, just a shade of undervalued is Target, ticker TGT. United Health, ticker UNH at $532, shows them as undervalued. You may have to zoom in a little bit, but they have the expected price for United Health here of $540 to $660 and the current price $532. Moving on down, we got Merck, ticker MRK. Check that out. 12 years of dividend growth and an A+ strong. Love to see that. Got a REIT, Public Storage, ticker PSA. $292 current price. Should be expected price $299 to $365. Application software company Intuit, ticker INTU. Next is Cigna, ticker CI, healthcare services company. This is one of the ones I'm interested in. Canadian National Railway, ticker CNI. $105 is their current price. They expect a price of $115 to $140. Very simple to understand business. 97, very safe. 2.32% dividend yield, and they have an A- strong balance sheet. And look at that. They've had positive free cash flow in each of the last 10 years. So that was one of the ones that I wanted to share some information with you on. Ticker KOF, Coca-Cola FEMSA. I think this is one of their bottlers. They look like they may be undervalued. 3.85% yield. Got Hershey in there. Checking in Hershey was flirting into the 140s at $150 now as this recording. Ticker HSY. NextEra Energy, a lot of you out there like NextEra. Hey, share in the comments below which of these you're buying, if any of them tickle your fancy. And remember, the future is unknown and unknowable, so this is not a buy recommendation for any of these. It's just to put them squarely on your radar. You got to do your own due diligence, but hey, anything can happen. So I don't think I would take Charlie Munger's advice to put all your eggs in one basket and watch that basket. Unless you're a genius like Charlie, then hey, knock your socks off. I am not. Next is Comcast, ticker CMCSA, undervalued. They show by quite a bit. Then there's Novo Nordisk, ticker NVO. That's one of the other ones we were going to do a little bit deeper of a dive on. But hey, sign up for Schwab, get the free account, look through the Morningstar report, and sign up for Simply Safe, and you can see all the same information I would have showed you. Elevance Health, ticker ELV, quite undervalued. They have a current stock price of $400. They expect their stock price $499 to $610. Again, doesn't mean it's going to happen. It's just expected based on the 5-year past price to earnings ratio, what they expect it to be. ConocoPhillips, I think Kevin was buying that, ticker COP. And bring it on home, we've got American States Water, ticker AWR, pretty undervalued, 98 very safe. They have been growing that dividend for 69 years. Bill and Ted would be happy. Diageo, been struggling. Not many young people are drinking anymore, it seems. I'm doing my part. I still buy Guinness. Love it. $124. They expect it to be $167 to $204. That would be quite the jump. We have American Water Works. That's an interesting one as well, in the same vein as American States Water, ticker AWK, American Water Works. And then the most undervalued, according to Simply Safe Dividends, Honda Motor Company, ticker HMC. $28 share price. They expect it to be 40 to 49, but they have only been growing that dividend for 1 week. But S&P does give them an A-, which is a strong credit rating. I know this was lightning fast, but hey, Papa's got a weekend volleyball tournament to catch in Indianapolis. That's a 4-hour drive for yours truly there and back. So check out this interview I did with Jonathan Glazer, who has been investing for over 50 years and shares some of his wisdom. So if you click that floating little box next to my head, we'll tell you all about his investing wisdom there.